Ba-dum-bum, ba-dum. It looks like we are live on all four channels. Hey, everybody, welcome. Come on in. Come on in. Episode 226 of the Winning Momentum podcast. Trying to do it live, trying to get into the routine of this. You know, yesterday I recorded this whole show live, except it didn't get broadcasted anywhere. I think it did on Facebook, and I deleted it. And the good news is that I did a terrible job. So yesterday, so I get to redo it, see if I can get through my notes a little bit better. Here we are with feedback from another from my laptop. I was looking on here just on LinkedIn for comments on a separate system because they don't go through on the StreamYard very well. Okay, that's enough waiting for everybody. Thank you for joining me. If you're listening to this recorded, thanks for listening. We are on all platforms that you listen to audio podcasts. And if you're listening to it live, please put your comments preferably into the LinkedIn live stream, although we are on Facebook and YouTube and Twitter all at the same time. The bottom line is I don't know service when the comments come through exactly, so we'll learn about that. All right. So today I want to talk about two things on the podcast. One is I had a listener to the show, a longtime listener, wanted me to touch on addressing competition in a business case or competition in a business pitch. So we will talk about that. And secondly, I want to talk about a public company that I'm interested in by the name of Canadian Premium Sand. So we're going to cover those two topics today. And if you have comments or questions you want to throw in, please feel free to do that as well. And we'll address everything that we can. So when I was way back when I was in university, I know, feels like 35, 40 years ago. And I took a marketing degree, notwithstanding that I'm a professional accountant. And when you take a 4-year marketing degree in my generation, you learned a lot of things, but it all came to an end in a course called marketing strategy. And in marketing strategy was basically about in what marketing they called the 3 C's and the 4 P's. I don't know if that's a current thing. Some of you younger listeners can let me know in the comments whether you learned the 3 C's and the 4 P's. But that was my favorite course by far in university. And I don't remember, 5, 6, 7 years ago, I became the chief restructuring officer of a global marketing company that did infomercials on various products. And it was a troubled business when I was there, but prior to that was a significant, successful business. And the exiting president that had been running the place, there was other people besides that, but the exiting president whose office I was sitting in, I was rifling through some old papers he had left on the desk. And this fellow is a friend of mine to this day. And on there was they were working out the launch of a new product. And on there, he had gone through the 3 C's and the 4 P's, which made me laugh. So, and we're about the same age. So certainly of my generation, if you're in marketing, if you're in that business, you learned about 3 C's and 4 P's. I don't know if the younger people do, but let's review those because I find, I tell this to my investment banking crew, to anybody that I'm trying to teach how to present something, an excellent way to think about structure in a confidential information memorandum, in a business case, in a pitch, about your market strategy and the positioning of your business, the positioning of your product or the positioning of your service, is this 3 C's and 4 P's. So what are they? 3 C's: customer, company, competitor. Think in your head of a triangle where the top point would be the customer, and the bottom left point would be competitor, and the bottom right point, right? So your top left, cameras work backwards, so I shouldn't be trying to do that with my fingers, but the bottom right point in your head would be the company. And so those are your 3 C's. And what you do with your customer on the top, and the reason they're on top is obvious, that's who we're trying to serve, is you try to segment those and put it into your target market. Okay. And so a target market is really a refining of who you're trying to market and sell to. And you're going to answer the who are they? What do they want? Where do they want to get it? Why do they want it? How can they go about purchasing whatever it is that you're trying to sell them? And you're breaking that down by target. An example would be if I am selling a phone, I might have, a very high price phone with a whole bunch of different features. And I may want you to go to an Apple store and talk to a genius to buy the right phone for me. Or I may have a really cheap flip phone or non-smartphone that's a burner phone. And those are different targets. They're different people. And so you want to segment the market. Okay. And that's on the customer side. And on the company side, don't forget, we're talking about competitors today, but on the company side, this is your companies, your products, your service strengths and weaknesses in supplying the needs of the customer, of the segment, of the target that you have identified, because you've said, well, they're trying to, this is the problem that they're trying to solve, and here's how we solve that. And then, but that's not just an absolute binary type of thing. It's not like we do it or we don't. We do it in relation to our competition. So what are your competitors' strengths and weakness in fulfilling that need? And I think where we trip up, you've all heard this idea of, you're starting a business, you need to solve a problem. You need to solve a problem. Well, that's helpful in thinking about the 3 C's as well. What problem are you trying to solve? And what is the current solution to that problem? So a competitor, and that's your competition. A competitor may not be just XYZ Corporation, right? Somebody else in the same business as you. And if you think that, then you haven't defined your problem very well, and you're thinking, or you're thinking about your competition too narrowly. Okay. And so what we're seeing, and the reason this longtime listener asked me to address this question is what we're seeing in business pitches and business cases, I think more and more, is the statement that we're unique and we have no competition. Right. And that never turns out to be true. Again, if you're saying that you don't have any competition or the competition is really weak, you're not really addressing the problem. What you're not doing is saying, okay, here's my target market and here's the problem specifically that I'm trying to solve. And here, as my competitor, is the current solution to that problem. So let me give you an example. I had 2 pitches presented to me a couple of days ago, back to back. And the first one dealt with competition in their business pitch terribly. And the second one dealt with competition in their business pitch very, very well. So what was the difference? Well, the first one, I can't tell you anything about it, obviously. I don't want to be disclosing things out of school, but let's pretend they're trying to sell you some apparel. Let's call it a shirt. That's not what it was. We're just making up an example. And this shirt is a smart shirt. It has some sensors in it. It has some cameras and technologies. Let's just forget about the idea that none of you want a smart shirt and you think that's a stupid idea. This was actually a cool product. But let's pretend it's apparel and it's a smart shirt. And what they said was, in their pitch, is they said, the market is everybody in the world, billions and billions of people that wear shirts, which is pretty much everybody on earth. Okay. So there is the market. And then what they did was they said, we are one of about 3 companies that sell smart shirts with all these sensors on them. And therefore the other 2 or 3 companies are our competition. That's what our competition is. And so, okay. But what they skipped over was the entire idea that not everybody on the face of the earth wants a smart shirt, right? That they didn't know, they didn't define well the problem that they are trying to solve. And the problem may be more than just, I need a camera on my shirt or a sensor on my shirt for whatever reason. The problem may be that I need to stay warm. I need to look fashionable. I want to be safe, right? You can segment out your market along different metrics. And what they focused on entirely was the people that made a competitive, smart product. Even though I think we can all agree in reality, in my ridiculous example, that very few people on the face of the earth would buy that product, because why would they? Right? You see what I'm saying? So it was a poor definition of the problem they're trying to solve, therefore a poor definition of their target market, therefore a completely nonsensical definition of who their competitors are. And I think this is how companies get themselves into this position. It just made no sense, certainly as the one receiving the pitch for possible investment. On the other hand, there was a pitch right after that in my group where we receive pitches. And this pitch was for a service, let's put it that way, let's call it coaching or training, something along that line. And it doesn't exist today at all. They literally have no competitors, but that's not what they said. That's not what they said at all. What they said is, here is the problem we're trying to solve. These people currently, they go off and do this other thing and they pay way too much money. And when they come out of that process, they owe a bunch of money and they're unqualified to do anything, right? Because they don't get this hands-on experience. We're going to change that. And here's how we're going to do that. So they've defined the problem that they're trying to solve, which helped them define their target market. And they define their competition by what the target market is doing right now and pointed out why it's so inadequate and how they're so much better. There is a different way to think about competition. I think the proper way to think about competition. And if you're not doing that in your pitches, in your business decks, in your business plans, then I think you're missing out. And so always remember the three C's, right at the top. You have customer, segmented into your target market that you're trying to go after, your strengths and weaknesses, and the competitor's strengths and weaknesses, and the competitor, not just X, Y, and Z, but the solution to the problem, the current solution to the problem that you're trying to solve. And by the way, for those of you asking what the 4 Ps are, they are price, product, promotion, and place. Price, and that's really how you compete with a current solution or a competitor. Okay, so you compete on price. Some customer segments, as I said with my phone example, want a higher price, some want a lower price. Product or service being the features that meet the needs. What problem are we trying to solve? Promotion is obvious. How is the product or service being advertised? How are you getting out to your target market? And then place, think of that as distribution. How are we distributing our product? How does the customer come and find us to buy our product and service? And obviously distribution doesn't start with a P, so they turn that to place. All right, your 3 C's, your 4 Ps, even if it's out of date, it's a really handy way for everyone to think about a business and how it's positioned and how they meet their market and how they compete with their competitors and how they define the problem that they are trying to solve. I'm guilty of this issue, by the way. I think that when I talk about Sinclair Range, when people ask me, particularly in the turnaround advisory side, I say, well, nobody does what we do. That's my first statement. Like, we're so unique, particularly in Canada. You know, we have some competition in the US, but particularly in Canada, what we do is, you know, we'll parachute in like a SWAT team into your troubled business, and we'll step in as interim president, interim CFO, interim CEO. We'll sit on the board of directors, and we'll help the current management team or replace the current management team, preferably help them to, transition, to get from here and there. And it's true that really nobody else does that in the Canadian marketplace. They do in the US, yet also has a professional firm, and the strength of that behind them, and also does the investment banking, raising the capital, sell the company or whatever. It's true that we don't have that competition, but it's not true. It's not true that troubled business doesn't have another solution, right? So even I fall into this trap. We have no competitors. The truth is, when I say that, I'm not defining the problem and I'm not defining the current solution very well, it's very easy to fall into that trap. And so the way to think about it is your 3 C's and your 4 P's, and to focus on defining the problem that you are trying to solve. And remember that your competition is how that problem's currently being solved, even if you don't see that as a direct competitor to what you're offering right now. Hey, welcome everybody on this live stream. If you want to say hi, just say hi in the notes. If you want anything you want me to talk about, if you have anything you want me to talk about, that's cool. I want to talk today about a public company I'm interested in. And I think it's kind of interesting. And also, if we were to review it, maybe we would learn some business lessons and pick up some jargon and a thought process for how we might analyze a company, both on the buy side and on the management side. And today I want to look at Canadian Premium Sands Inc., which is a Canadian Premium Sands Inc., a Canadian company listed on the Toronto the Venture Exchange, TSXV, which is a small cap market, and not really over the counter. It's better than that, but it's certainly not large cap. So it's pretty tiny companies that are on there in the grand scheme of things. Its symbol is CPS. So Cat, Peter, Sam. Yeah, let's put it that way. CPS, Canadian Premium Sands. And so before I start on this, I just want to give you the disclosures. I am not a financial advisor. I'm not encouraging you to buy stock. I'm not encouraging you to sell stock. I'm not encouraging you to do anything. I'm not advising you to do anything. I'm just walking you through a company that I am interested in, and I'm going to give you my thoughts about it. And if you can learn something from that, that's cool. But I'm not a financial advisor. We're not qualified for that. None of the companies that I run or own or operate are financial advisors. Okay. Secondly, I'm not selling you anything. There's no course associated with this. I'm not trying to sell you any securities. We have nothing to sell you in this regard. If you're a longtime listener of the Winning Momentum podcast and its predecessor, Martinis with Scott, well, you know what we're all about here, which is helping business people and those interested in business become better educated, learn some strategies for being successful and turning things around and gaining that winning momentum. So we're not selling you anything. I have no inside information on this company whatsoever. All right. So everything I'm going to talk about is from most recent publicly available information. Having said that, I do have a friend and someone I respect quite a lot on the board of directors of this company, but I have not talked to him about this. I don't think he even knows we're going. Well, I'm certain he doesn't know that we're going live with this. I did invite someone from the company to join on this live stream if they wanted to, but we didn't get schedules aligned. Maybe we will in the future and we can do a follow-up on this, but it would be cool, right, to have a CEO on here that we can talk to, and I could ask some questions and express some concerns, and let's see whether this stock makes any sense for me, for Scott, or for Sinclair Range as an investment. So those are the disclosures. Let's get into reviewing this company. Company issued a press release which hit my desk June 15th, so a week ago or what have you. Now, unfortunately, the press release was dated May 11th, not June 15th. I'm going to guess that that's a typo in their press release. I don't think they drafted a press release May 11 and hung on to it for over a month to release it. Maybe, I don't know, but let's just go with the idea that it was a June 15th press release and not a month prior to that. And I'm going to talk about sort of the bullet points in this press release, and then we'll dive a bit more into what this company does, what some of these terms means, and how to think about this. So the press release starts with 3 binding commercial offtake agreements. They've entered into 3 binding commercial offtake agreements. I'll tell you what an offtake agreement is shortly and why that's important. They've been signed and they represent collectively a minimum of 62% of planned output capacity and could increase to 77% of planned output capacity. They've entered into multiple memorandums of understanding that have been signed, and they represent 170% of planned output capacity. And they expect those MOUs, memorandums of understanding, to convert into offtake agreements as a sidebar, a memorandum of understanding is a document perhaps not drafted by a lawyer, more by business people, and it sort of bullet points out, here's what we intend to do, here's what you intend to do, we understand that things are going to work this way, and here's the service you're going to provide, and there's the way I'm going to pay for it, and so on and so forth, okay? And then what you often would do is that memorandum of understanding would be non-binding, and you would send it off to the lawyers, and they would turn that into a more comprehensive legal agreement with all the protections and bells and whistles that you would expect as part of an agreement. And so MOUs are a quite common tool. We use them all the time in our business. I remember years ago, I was working on a potential deal in Cairo in Egypt, where the counterparty would have been the Egyptian government. And we were making some progress, and we had 2 MOUs in place. And I hired counsel in Cairo that, were trained in the West, spoke great English, and, they were very much ingrained into Egypt and into the government. So they, as far as hiring lawyers in a foreign jurisdiction that not much about, they're pretty great lawyers. And I was waving around proudly my MOUs, to which the lawyer looked at me and said, "We are unfortunately a culture of MOUs." I never forget that line. In other words, they sign MOUs all the time, but to get it from here to an actual document, to an actual deal, maybe that's not going to happen if you're in the culture of just signing MOUs all the time. And sure enough, that deal didn't happen or get anywhere close to happening. All right. Pre-construction engineering and design is complete for a turnkey EPC agreement. And that's been signed and provides cost certainty. So an EPC agreement is engineering. I had to look this up to remind myself. Engineering, procurement, construction, EPC, engineering, procurement, construction. Basically, you want to build a factory or something large that costs a lot of money, and you don't have the expertise of doing that. So you just put together a consortium of construction companies, engineers, designers, whatever, and you send the whole thing off to them in a turnkey fashion so that you just write the checks and get a plant or whatever you're trying to build at the end of the day. So they've done that. They say that the offtake and the fixed cost agreements provide a certainty on the economics of their project, and that it will provide a tremendous IRR, which they claim to be 18%. I don't really have any specifics on that, so I won't comment further. They got some of their environmental certificates in place, hired some new management, and started a financing process for all of this that they initiated with what I take to be 2 investment banks, Fort Capital Partners and Peters & Co. Limited. So Fort and Peters, and those are the advisors on the financing. All right, so that's a pretty comprehensive press release. It got my attention since I track this company on my screen. And the reason I track it is I like the business they're in. I think it's interesting and kind of cool. So the company is developing a business to manufacture patterned solar glass. Patterned solar glass. Well, what is that? That's a high performance, low iron glass with very high solar energy transmittance. Okay, so it's designed in such a way, and its raw material has very little iron, and it's designed in such a way that it transmits solar energy very, very well, much better than the alternatives, is the way I understand it. It's made by melting raw materials, primarily consisting of high purity silica sand, and drawing the molten glass flat with patterned rollers, and the rollers imprint a permanent prismatic pattern into one side of the glass to improve the light transmissivity for a more efficient solar panel. Okay, so that's what they are developing, they say, and the manufacturing facility will be in the province of Manitoba in Canada. And they're currently raising sufficient capital for the construction and the operation. In addition to that, the company has 41 quarry leases located also in Manitoba, about 160 kilometers north of Winnipeg, the capital city of Manitoba and the main city in Manitoba, that grants the company the exclusive right to quarry silica sand, which we already said it was the input for this class, which the company intends to use as the feedstock for the glass manufacturing plant. The sand has been laboratory tested. It is unusually low in iron, and I don't have that on my notes here, but I understand that makes these particular quarries like one of 4 deposits or something like that in North America that actually have this high grain silica sand that's low in iron that can be used to build these solar panels. So they have some exclusivity and some scarcity on their input needed to make this solar panel glass. And they've also said that they have enough access to the silica sand to run this plant for 50 years. Okay. So that's kind of cool. And then if you think about it, well, before you think about it, so in the US, or actually it's a North America stat, the Solar Energy Industry Association is estimating that the North American solar panel installations are to increase over 20% on a compounded basis annually. So 20% annually compounded in the next 8 years. Okay. So rapid growth. That's a lot of growth in any particular industry. And there's currently 100% of the supply of this pattern glass to North America is sourced from Asia Pacific based manufacturers. Okay. So nobody in North America makes this glass. This company would be the only one. And if you think about it from a geopolitical and from a freight cost perspective, which is out of control in the world, we need to start onshoring. We're seeing a huge trend in onshoring some of our manufacturing. And so you've got 20% compounded projected organic growth in the industry itself, plus the idea that you would be the only manufacturer in North America that could make this when everybody's looking for North American solutions. So your market share can explode. Plus, you're the only one with access, or one of few people with access, or companies with access to the input required to make this glass, because you have these quarries tied up. And my understanding is that these silica deposits, that was the original business plan of the company. I think I'm sort of guessing on that, but that's what I understand. So that was the original plan for the company, because certainly they could extract the silica and they could ship it off to Asia or who's ever going to buy it to manufacture whatever, right? And then they lab tested and found how pure it was and how low in iron, more specifically. And they thought, and then they learned what that's good for, and they thought, wow, we could build this plant and have this amazing business plan, which sounds pretty cool. So that's the overview of the company. It's why I'm interested in the company. Welcome to the live streaming of the Winning Momentum podcast. If you're listening in, you can throw in comments, say hello. But in the meantime, we're just carrying on with this review of Canadian premium sands. And so the press release, I want to go back to this offtake agreement. The press release referred to offtake agreements, and it says they've secured commercial offtake agreements with 3 North American solar panel manufacturers. And then they list the 3 manufacturers whose names I can't pronounce, and it doesn't matter anyways. But the bottom line is they have these 3 agreements, and that provides certainty or comfort on the ability to sell their product, to sell their glass after they manufacture it. So what is an offtake agreement? Well, it's kind of what I just said. Let's say you're mining. Let's make it up. Let's say you're in a nickel mine, right? And so you're spending a bunch of money in the, to develop, to drill holes, to put in safety, and to, buy the equipment to refine. And so you spent all of these hundreds of millions of dollars on a nickel mine. Well, you want to know that you have somebody you can sell your nickel to when you're done all that. And that's called an offtake agreement. So you go to a purchaser or a broker of that particular commodity and you say, hey, this is what we're going to do. We're going to invest all this money. When we have some product that you might be interested in, will you buy it? Yeah, I'll buy it. Why wouldn't I buy it if it's this grade If it meets this spec, I'll buy it for sure. Cool. Can we enter into a contract to that effect so that we are able to get our financing and provide certainty to our stakeholders that we're able to sell this stuff at the end of the day? And that's kind of what an offtake agreement is, okay? And it's a commitment to buy if and when there's something to buy and it meets the spec, is basically what it is. And it could come with some money up front, right? That prospective purchaser may invest as part of that offtake agreement, but it doesn't have to. It's really just an idea that if you're making something, there's somebody out there to buy. And if you think about it if you wanted to go buy some stock in this company today, you'd be thinking to yourself, wow, they've got this input. They got to build this plan. There's risk associated with that. They come up with this glass, but they're not glass people. There's risk associated with that. And now we need to sell it. Is there a buyer? Well, the offtake agreement mitigates to a large degree that risk. Devil's in the details. We don't get to see the contract, but the offtake agreement is really important to mitigate that idea of, can you sell it? And it's a really important part of project finance. And here's, a lesson that we should all learn about project finance. In this case, you have this massive project. What does that mean? Well, massive means it's going to cost a lot of money and you're basically starting from scratch. This is not an existing business that you're trying to improve, that you're trying to grow. You're starting from scratch on a new project. And that project in this case is you're taking a bunch of input, which is the sand. You're manufacturing glass with that sand and other things, presumably, but you have this big manufacturing plant, okay? And then the output is this patterned solar glass, which you then need to sell. That's your project. Think of it in 3 steps: the input, the processing, the output. The logical question on the output is, can you sell it? The offtake agreement deals with that. The logical question about the input is, can you buy it? Do you have access to it? The quarry licenses that are exclusive to Canadian Premium Sands answers that question. They've said it's 50 years. Okay, I don't have due diligence access on that, but let's just take that disclosure for granted. So they've got the input covered, and the offtake agreements tell you that the output is covered. What are you left with? You're left with this big manufacturing plant in the middle, which they have also said is covered by the EPC agreement. Okay, so let's get into that. Construction. Always think about your project finance that way, by the way. That's the right way to go about it. And then you need to mitigate the risks at every single stage of your project, whether that's 3 stages or 100 stages. It doesn't matter. You need to be able to define it, the costs associated with it, and mitigate those risks as much as possible. So often you see financing requests for this sort of thing, and they've done nothing to mitigate the risk. So that's a problem. Okay, construction. They give a bunch of details on the plant that they're going to build in some of their disclosures. I don't think we need to spend our time talking about that, but because who cares? But they've entered into this EPC consortium to design an 800 ton per day solar glass manufacturing facility. It gives you the specs on the glass that they're going to produce. Here's the more interesting part. Company has entered into preliminary construction agreement with an EPC consortium that incorporates a guaranteed maximum cost of $880 million, which is inclusive of the silica sand operations and provides for turnkey project execution, including specific operational performance guarantees for the project. So the budget for this plant is not to exceed $880 million. One can assume it's not going to come in a ton less than that. So let's just use for this purpose $880 million for this manufacturing. Okay. They've got the input. They've got the output covered with the offtake agreements, how we sell this stuff. Now they got to build this plant. They've got people that are going to build it. They have it designed in spec. It's on a piece of paper, but now they need to pay $880 million to fund this construction of this big plant. It's a very large startup project finance issue. Okay. Now the economics of the project, when it's done, they say they're going to have revenue of $300 to $330 million per year. Okay. So that's the annual revenue. with EBITDA of in the range of $170 to $190 million per year. So free cash flow of, call it on the upside, in the $190 million range on revenue of $330 million. I don't understand how that makes any sense. That is a huge margin on EBITDA. I guess the idea here is that there is no variable cost or very little variable cost associated with this production, and the amortization of fixed costs is over a really, really long time. So that must just be an accounting anomaly. But the free cash coming out of this thing is significant. And then they say there's a greater than 18% unlevered IRR, an internal rate of return. There's no math that supports that whatsoever. You have to ask yourself, over what period of time would that be? What if the project's delayed a year? That's going to mess with your IRR. So personally, again, the idea here in this podcast is for me to discuss and for us to share how we might analyze a company. I see this 18% IRR with no backup. I just ignore that personally. But you do have my attention with this $190 million of free cash flow. You have my attention with that. Okay, so all of this sounds amazing, right? We're in a great industry. We clearly have a sophisticated management team, and we have the inputs, we have the outputs, we got the offtake agreements, we got the EPC agreements to build this plant. All we need is $880 million, which is very often, as you might imagine, where these projects start to fall apart. So financing, it says initiation of formal financing process. The company is pleased to announce the initiation of the external capital raise for the construction project. It's engaged the two investment banks that I referenced earlier as co-financial advisors in connection with this process. The company does not, here, this is a very important sentence in these releases. The company does not intend to provide any updates on the progress of this initiative until a definitive outcome has been reached. So we're not going to tell you how we're doing on this raise. We're going to come back to that a few times. So as a potential investor, a purchaser of the shares of this public company, because you like everything they're doing, it all kind of comes down to, can they raise this $880 million? And if so, at what price and in what structure? But they're not going to tell you that, what their intentions are, what their hopes are, or how they're doing along the way. Now, by the way, in fairness to the management team, I'm certain they have a bunch of lawyers telling them that they're not allowed to give you that information, to make promises, to put on the capital raise. It's a material risk, and you don't want to entice people to buy into the stock now in anticipation of that raise getting done. So it's a tread lightly kind of issue, I would imagine. Again, I have no inside information on this at all. I've never talked to anybody at the company about it, but I would imagine it's a tread lightly kind of situation when you talk about, are you able to raise the money or not able to raise the money? But from a shareholder's perspective, they've just flat out told you you're not going to get any information on this, which means you just need to hold your breath, hope that your interests are aligned with the insiders who are actually trying to get that raise done. So, as I said, they're likely raising $880 million. Now, would that be in debt or equity? Well, it's a startup company. It's pre-revenue, right? They've spent so far $5.8 million as at March 31, it appears, on building the plant, which is, I think, would be all soft costs, getting permits, getting their design done, all that sort of stuff, so they could even get to the point where they're trying to contract with the consortium to go build this thing. And so they've spent the $5.8 million, they're pre-revenue, and now they need another $880 million, and it will still be pre-revenue. So I don't want to hold myself out as a project finance expert, because I'm not, but I'm doubting there's much debt that would come along with that. I'm suspecting most of it's equity, because there's no cash flow to service debt. And in any event, the debt would be, if there was some amount of debt, it would certainly be convertible or have equity kickers. So I'm going to assume, for the purposes of my analysis, until the company tells me different, that this will all be equity. And by the way, the company's not going to tell me different, because in their press release, they said they do not intend to provide any updates on the progress at all, ever. Right? So I'm left to assume that this is all equity. So A little bit of context on the liquidity financial highlights of Canadian Premium Sands. Company has a deficit of $41 million, more or less. That's at March 31. We already know they spent about $6 million on the plant already on the same date. I'm not sure what the rest of the deficit is. It's possible that this was an existing public company that they sort of rolled into. We've talked about reverse mergers before in rehabilitating old companies, and some of that deficit may have come from them. So I don't know. I didn't go back that far to look because I don't really care. They have cash and cash equivalents of $3.5 million or $3.4 million as at March 31. So they have a little bit of cash in the bank. They don't have much debt. I think it comes out to about 4.1 million. One thing I'm always looking for in the analysis of a company for investment is if I'm buying common shares, who's ahead of me? How much debt do they have? Can they service that debt? Can they pay it off in the normal course? Will it be converted into stock? And I think in this case, you need to say, well, yeah, some of it's probably going to get converted. Potentially, I don't know. But in any event, it's $4.1 million out of an $880 million problem. So I'm not really stressed about that one way or the other. And as again, on financial highlights, as I've told you, this is pre-revenue. All right. So there's sort of the background, the overview, defining the issue. So let's do a little thinking and analysis on this. Well, actually, let's get into some valuation and shareholdings first, because that's always fun. So I wrote out my notes yesterday, and yesterday morning, the stock was trading at 51 cents a share. I think when I looked this morning, there were no trades. But anyways, let's use 51 cents or 50 cents as a round number for the market price of the shares. 78 million shares outstanding, which would give you a market cap, a valuation from the market of the entire company at $40 million. There's a 56.2% float. You're looking at public companies, you always need to look at the float. What does the float mean? If you have say 100 shares outstanding and 40% of those shares or 40 shares are held by insiders or large investors or investors that are restricted from trading their stock for a certain period of time, then those 40 shares are not available in the marketplace to be traded, right? But 60 shares, therefore, are available in the marketplace to be traded. That, in that hypothetical example, would be a float of 60%, right? So 60 shares are out in the market trading. 40 of those shares are not out in the market trading. So you have a 60% float. That's what a float means. It's not really a technical term, but just in generalities, that's what it means. Why is that important if you're looking at a public company? Well, one reason would be that the more float you have, the more true the market, right? And the less float, because you have more shares out there and no one's able to, it would cost more money to manipulate the market. Like if you do a press release, if you have a small float and you have a press release and a bunch of insiders on the strength of that press release, preferably after the release went out, and they weren't front running this, but after the release, if they buy a bunch of stock and you have a small float, well, the price is going to go up. Price is always supply and demand. If you have less supply because you have a less float, then that stock will move up, and vice versa. If you have, that's demand. So you got a lot of demand from a press release, somebody buying, you don't have much supply, the price can go up quickly, but then the price could go down quickly as well. And so that's why, as an investor, you always want to look at float. And in these small micro cap companies, it's really important for a management team to think about their stock, in my opinion, to think about and I'm not a securities advisor or a lawyer or a securities registrant, so this is just my opinion. But nobody ever trades these stocks because nobody ever knows about these companies and nobody's really paying attention. I don't mean nobody, but it's a very, very small market. And so if you want to be successful, not your business, but your share price, creating value for shareholders, you need to think about your shares and your stock as almost a separate product, divorced from the business, if that makes any sense. Okay, when you're much larger cap and you've got a lot of interest in your company, and you qualify for funds to be able to invest in those shares, theoretically, the market is the value of your company, the efficient market hypothesis, which doesn't really exist, but it is a hypothesis. And so theoretically, that's the way it is. But in microcap, you don't have anybody that knows about your product. There's very little demand for that type of stock, and so it's kind of divorced from the success of the business. And so what you need is a management team that is conscious about the need to continually make a market, as they say, to make sure people want to buy the stock and that there's stock available for people to buy. Otherwise, you have no liquidity and ultimately you have no value, no matter how well your business is doing. Anyway, so always think about float when you're into these small cap stocks, for sure, micro stocks. 52-week high low of 62 cents and 29 cents. The 62 cents, this is not kind of up and down like this. Every stock is up and down, but it seems to be going up. The 62 cents is after the interesting press release, or running up to the interesting press release. Volume. You always want to pay attention to volume in a stock. The average 3-month daily volume is 8,000 shares. So what does that mean? That means in the last 3 months, on average, 8,000 shares traded a day. Remember, we're at 50 cents, which means it's $4,000 a day on average. So what does that tell you as an investor? It tells you, wow, if I have $40,000 invested into this company, it could take me 10 days to get out of this thing if I was 100% of the trading that day, which I'm clearly not going to be. So it's going to take me much longer than 10 days. And I'm probably going to drive the stock down by trying to exit. So the volume needs to be a limiting factor potentially on how much money you want to put into this type of stock if in fact you are trading. Okay. Again, I'm not a financial advisor. I'm just telling you from my point of view, the way that I look at things. And another thing to look at is that, how does that average volume happen? Because in many companies, including this one, it appears to me that you get multiple days of really no trading, or very, 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 very little trading, followed by spikes of trading on news releases, or when something interesting happens, or when someone's trying to dump a position or put some money into the stock. So for example, 2 days ago, this company traded 265,000 shares, or 130 grand at 50 cents a share. And so, you take that into account in your averages. What else? I took a look at the holdings of this in the insiders and institutions that have percentage owned in the company. I don't think that's really telling us anything, so I'll skip past that in the interest of time. I will say that insider trading reports, there was a Mr. Vishal, I would think is how you pronounce his name, Vice President of Corporate Development, who it says on May 15th, purchased 119,000 shares for $65,000, 54 cents per share average. So it's cool that you have an insider who believes so much in what's going on that they're spending money at 54 cents, sort of the high end of the 52-week range, and not a little bit of money, like a significant amount of cash, $65,000 roughly. Okay. So there's all the background, the stats, the things that I would look at for this sort of company to analyze it. Now let's think through what this means. Should Scott buy some stock? I almost said, should you? I'm not advising you, so I'm not going to talk about that. But should Scott look at this thing more closely? Well, I love that the space is clearly growing. It's modern. It's on the clean energy bandwagon. There's a need for it. Growing 20% per annum compounded over the next 8 years is the estimate. Plus, nobody in North America makes this class. It needs to be onshore. There's all sorts of political and cost of business, freight costs, reasons for doing that. So the demand is going to be huge. They have the offtake agreements to prove that. They've already got customers signed contracts, prospective customers who have signed contracts, said, yeah, we want to buy that product. That sounds great. They have the input tied up to this project for 50 years, they say. So that's amazing. They've got that all done. There's some royalties associated with that, I believe, but they're not going to be consequential in the big picture. They've got a fixed cost deal in place for a turnkey plant, the middle piece of this project, and the finance that goes along with that. So they got that with very credible large companies in engineering and construction. So they've got the consortium in place. They've signed the contracts. They know the numbers, and the numbers work in terms of profitability, right? We talked about this $190 million upper end of free cash per annum when this is all done and operating as it ought to be. So these are all the reasons I'm excited about this company. Now, today we said they're valued at 40 million. 40 million is what we would call pre-money. Okay. What does pre-money mean in valuation? We've talked about this before on the podcast. It means today we're worth 40 million, but we're going to make zero cash until we've invested another 880 million, and then we're good to go. Okay. So the pre-money is 40 million. The money is 880 million. The post-money is the sum of the two, which off the top of my head is 920 million. Okay. And so what you end up with, something to think about, is if the money comes in at the same valuation as the existing shares, the pre-money valuation, then the current shareholders, and if I were one of the current shareholders, which I'm not yet, I should have told you I have no ownership in this stock whatsoever right now. That would have been a fair disclosure as well. You would end up with less than 5% of the company. In other words, you have to dilute the company, if it's at the same valuation, by 95% plus to get the financing in to build this project. Okay. And so to put that into context, well, not for context, but let's talk about how this works in terms of valuation. So you're raising $880 million. We're going to assume it's all at equity. We're going to assume it's 50 cents. So it's the same as what we're doing right now. Well, that's an additional 1.76 billion shares. We can round that up to 1.8 billion total shares outstanding just to account for the existing shares right now. Okay. And if you have the EBITDA, the free cash of 190, let's call it 200 million for round numbers, right? What is that 200 million of EBITDA worth? Well, let's put a multiple of, say, 8 times on that. And a lot of you will argue that that's too low of a number, but it's a number that I like. So you've got an 8 times multiple. 8 times 200 million is 1.6 billion. We said that there'll be 1.8 billion shares outstanding with all those assumptions. It means that you end up with 88 cents per share, and you can buy this stock at 51 cents this morning. Okay. So your bump with that set of assumptions would be 51 cents growing to 88 cents if in fact they can raise $880 million and generate the cash that they say that they can generate. Okay. That's not much of a return for that risk, is it? It doesn't seem like it to me. Now, again, you might want to change your EBITDA multiple assumption. I don't, but some other people might want to do that, which would influence this. Okay. Or you could say to yourself, yeah, but Scott, they're going to raise the $880 million, some in debt, some in equity. Maybe, but we have no evidence of that. The company hasn't told us that. They're not going to give us any information. I don't think you can assume that they're going to have a bunch of debt. I also similarly don't think you can assume that they're going to raise money above market value today. Right? Or is someone going to say, cool, I'll give you $880 million at $1 a share in a 51 cent market? Do you think that's going to happen? It's not impossible. You know, I was once, one of my claim to fame is I once raised lots of money, millions of dollars back in the day at 81 cents a share in a 3 cent market, right? It's not impossible because you're really selling the prospective value of the plant that you're building. And this is such an, the new money, as I said, is 95%, depending on the valuation. And the old money is 5% of the valuation. So it's the new money that drives everything, obviously. And you're going to base that on perspective. But still, I don't think you can assume, I wouldn't want to take the risk that they can raise money at, say, $880 million in a 51 cents market. Might be possible for them to drive up the stock from 51 cents to $1 first and then raise it in that market. That's not unheard of in the biz. I don't know, but I can't assume that because there's no updates from the company coming on it. And I would point out that there's a real prospect that they raise $880 million at a lower number, say 30 cents a share. That's a possibility. I'm not saying that's what's going to happen. I'm just saying you need to consider these possibilities. And I went through the math quickly on that. And if you did, and then you bought 51-cent shares today, and then they raise $880 million at 30 cents, well, you would be crushed. Using the same assumptions, it looks like the valuation would be more around 20 cents a share by my math. I'm sure there's some assumption challenges that could be in there, but in other words, it's not a good deal. So to me, I love this company in terms of the business. I love the management team. They seem to be doing a great job. But in terms of a stock, I don't like it at all. I don't like that I could get in 51 cents today. What's my upside? If they raise all this money with all of the information that I have and the way I think about the assumptions, they raise all this money and they do it at 880 million at 50 cents a share. The bump for, and then they meet every metric that they've said they want to meet. My upside's not very much, right? It goes from 51 cents to 88 cents. I think that's the number I said. That doesn't do a hell of a lot for me, given the risk associated with that trade. Okay. My math. Now I'm prepared for all of that to be wrong in reality. Things change for one reason. Things change really quickly when you're out trying to raise that amount of money, right? You could get strategic partners in. Strategic partners are people in the industry, some of the people of these offtake agreements, and they agree to not be so hung up on share price because they're more interested in the strategic benefit coming out of that. Maybe we learn that, right? That could change all of these assumptions. That's possible. Things could get better. Market could go up. Things could get worse. I don't know. But that's the whole point. The whole point is we don't know based on current disclosures. I've told you everything I know. And if we had someone from the company come on at a future date, maybe we could ask some of those questions, but maybe they're unable to answer because of their handicap on disclosures during the raise process. I have no idea. So, but that's my math. That's how I analyze this. This has been the Winning Momentum podcast. Thank you everyone for listening, those that joined in live and those that are listening later on the recorded. What else can I tell you? We're on every platform. You can check out thescottsinclair.com and audio podcasts, of course, everywhere you listen to them, Apple, Spotify, Google Play, all that sort of stuff. Thank you for listening. We'll talk to you again next week.